Let's bring in Mukul Kochhar, Head of Institutional Sales at Investec, who's joining us on the show right now. Mukul, thanks very much for taking out the time. What are you making out of the market setup currently, keeping in mind what's been happening globally, as well as the kind of fund activity we are seeing over the last few months?
Yeah, so we've had this call since late last year, early this year, which honestly hasn't really sort of changed much. One is we've been calling for a weaker rupee, and that is something that while not structural, at least in the medium term, the factors contributing to rupee weakness, we don't see any change in that, and we can discuss that in more detail. Now, when you sort of overlay that into portfolio construction, that has substantial implications, because when you talk about rupee weakness, you're sort of you will build your portfolio in a certain way. Not only is a weaker rupee beneficial for exporters, a weaker rupee will also be inflationary. It will also exert pressure on interest rate yields, so you would need to think about that. So that is the first assumption when we get into portfolio construction for this year, and we've been playing that. Moving on to the second point, which has been a broad theme that we've been playing for the last 3-4 years, which is private financials and the market share gain that they have, and it's largely predicated on so financial services is a business of cost efficiency on one side, which gives you cost of funding. The second is distribution. So the private financials have built a better distribution network than the PSU network. The second factor is on the cost of funding or the cost efficiency. They've caught up over the years as their CASA has built up. So as these private financials have come off size and their cost of funding has improved, the share shift has actually accelerated. So we don't see that changing. There's still a substantial wood to chop over there. So the first is, we prefer private financials. Now within private financials, you have banks and NBFCs, and we're veering towards banks in this cycle. So from here, it's largely because of the first point we made, a weak rupee alongside a strong crude is inflationary. We see inflation picking up. There could be hardening of rates alongside that, which is not an ideal environment for NBFCs. NBFCs, you have to remember, have come through years of a couple of years of margin expansion as well, which either will peak or may reverse slightly. Banks, on the other hand, have sort of a more fixed cost of funding. So banks in general, I mean, as not to belabor the point too much, will be a better bet to play out here. And the banks that we prefer are ICICI Bank, HDFC Bank, RBL Bank, Yes Bank, DCB Bank, and amongst the regional, City Union and Karur Vysya. So that's as far as the bank sort of
Right.
financial space. The last leg that we've been talking about is also related. It's discretionary consumption. So this is broadly
Mukul,
the market setup that we're looking at.
Mukul, so we talk about the consumption space now. You were talking about that being the third pocket. Just did a piece this morning about how stocks, which at the markets perched at new highs, the share of the large cap names in the list of the all-time highs, and consumers top that list. Don't valuations look a bit stretched?
Yeah, so this is an interesting point. So, FMCG is where, the valuations get into stratospheric sort of levels. But, so part of the reason for high valuation is the negative working capital that most companies in the consumption space enjoy. When negative working capital with 10 to 15% growth, it's a very, very powerful lever for valuation. So the high valuations are deserved, but some of these valuations, are at levels where forward returns should be sort of tempered. So we are talking about, discretionary consumption pocket, not the staples. Staples is where the valuation is much higher. Discretionary consumption, they're sort of, so for instance, Bajaj Auto, which we are talking about recently, there's a price war that happened. Stock is very depressed because they opened a front on the economy segment of the bike space to gain market share by dropping price. Margin came off really poorly in the last quarter. The valuation here is really, really undemanding. And this is another leg of the financing piece that should benefit. Now, two-wheelers are not a sexy space. It's not a high growth space. It's sort of penetrated in the market. But two things can happen here. One is share shift in front of in favor of certain players, and we think Bajaj Auto may be one of them. And second is some margin expansion from here. So in the context of that, roughly 14 to 15% forward multiple is undemanding. So you can still find some pockets here for discretionary consumption where you may want to play. But yes, I do not disagree with the fact that the staple space is fairly pricey.
What about the four-wheeler space, and comment on Maruti in particular? They've come out with the new Ciaz, given it a facelift, expect to ride the wave on the volume side with it. Do you see that progressing for them?
See, Maruti is a stock that we backed for years, and the stock has done well, and the call has really done well for us. But to be honest, we are at a point where we are sort of looking at the stock again to see where it would go. We want to see how its partnerships that it has evolved, how the actually the structure with which it's operating under Suzuki as well, and the partnership it has evolved with Toyota, how that impacts the base business in India. So we are evaluating that. But otherwise, the business is exceptionally good and strong. Maruti has shown the capability of launching models which competitors just cannot even come close to. They've over the years expanded their market share, and they've kept it there. And a lot of the competitive advantage for Maruti is sustainable in the fact that they have a very good resale market. Their rural distribution is unmatched. So the stock we like per se. It's just that in the context of these partnerships, we are reevaluating a call here.
Anything interesting that you could see in the cement space? We've been seeing cement prices remaining weak of late. I mean, all India prices have dropped by 1.8% on the back of results posted by some of the cement majors as well. What's your call?
So, in India is one country where cement doesn't trade like a commodity. I mean, it's an interesting sort of, conundrum. I mean, so cement is early cyclical. So when you see the cycle coming, the stocks should be bottoming, and then you play them, and you sort of get benefit of that. But having said that, stocks are pricey in India, in cement stocks, and earnings have been promising to deliver but have not delivered for the last 3, 4, 5 years. So when you talk multiples on realistic numbers, these stocks are expensive. So we are playing a cautious sort of game on cement right now. On the sector itself, we have an underweight stance. Within cement, though, there are certain companies that are doing exceptionally well, consolidating the sector, growing. Over the years, they made very good acquisitions. One of these companies is UltraTech Cement. So if you just want to sort of play the space, play the consolidator, which is UltraTech, but overall, the sector can be avoided. You have to remember that there's cost pressures coming. We just wrote a note this morning that Portland slag, which goes into cement manufacturing for some of the players, has gone up. Petcoke prices have gone up. So raw material prices have gone up. And as you just mentioned, companies are finding it difficult to pass through. So there could be potential further pressure on margins, and with multiples high, we are not that constructive on the space.
Well, very quickly, just one last thought. Pharma stocks have jumped up, not just today, but over the last couple of months. Do you find merit? Do you guys find merit? Are you recommending these stocks to your clients?
See, pharma, fundamentally there is still trouble in the US, undeniably. However, there are pockets of value. We are recommending Cipla and Aurobindo Pharma to clients. Cipla just because of its very, very good franchise and extremely strong domestic franchise as well. Lower exposure to US. Aurobindo just because of its pipeline and its ability to get new products through. We are, on the other hand, cautious on a few stocks. The recent rally, could also be, when you look at, when I initially started by saying, okay, you should do portfolio construction, taking in view the rupee depreciation that's already happened, and the fundamental factors still in place that may put pressure on the rupee. Now, when you try to translate that into a portfolio, the very obvious choice is IT. And we've been playing that, but beyond that, getting very liquid names for exporters is difficult in India. So naturally, then the choice comes to pharma, and despite therefore some of the challenges, business challenges that are there, which is pressuring earnings down, when people want to play exporters, pharma becomes the natural second choice. So some of the action there is probably related to the weak rupee as well. But fundamentally, you got to be careful with a few stocks, and we're laying our bets selectively out here.
Thanks, Mukul. So good having you. Much appreciate you taking the time out. Look forward to have you more often on our forum.